bonds with contingency provisions. A contingency provision is a clause in a legal document that allows for some action if the event or circumstance does occur. This is also called an embedded option. We are going to talk about three types of bonds which have contingency provisions: a callable bond, puttable bond, and a convertible bond. Let's start with a callable bond. A callable bond gives the issuer the right to redeem all or part of the bond before the specified maturity date. To understand this concept, let's take a look at a simple example. Let's say we have a given issuer, company A. Company A issues a bond which is a 10-year bond with a par value of 1000. And the company in the bond indenture says that the company can call the bond back after 5 years for 102% of par. Now, what does this mean? Given that this is a 10-year bond, after 5 years, if the company wants to, it can pay the investor 102% of par, so that would be 1020, and redeem the bond or call it back. And hopefully with this explanation you understand why the option that the issuer has to pull the bond back or bring the bond back is an embedded option. That option has no meaning without the bond itself. That option is embedded, or it is part of the bond. It's not like a call option on a stock that we will discuss in derivatives, where the call option can be bought or sold without the underlying stock. Here, the option that the issuer has to call the bond back only makes sense in the context of the bond. The embedded call option is beneficial to the issuer because it protects against a decline in interest rates. Let's understand this through a simple example. Let's say a company or an issuer issues a 10-year bond with a par value of 1000 and a coupon rate of 10%. Let's say that when this bond is issued, the market rate is 10%. This means that the issue price is going to be 1000. A year later, the interest rate or the market interest rate comes down to 8%. Now, who does this benefit? If you think about it, the investor will be very happy because an investor is getting 10% in an environment where the market rate is only 8%. So the market value of this bond will go up. What about the issuer? The issuer will not be happy because the issuer is paying a 10% rate in an environment where interest rates are only 8%. If this bond is callable, then the issuer can call the bond back at a value which is lower than the market price. Another way of looking at this is that the issuer can borrow again at 8% and then use the proceeds of the borrowing to pay off this original bond where the interest rate is relatively high. So notice that this call option or the embedded call option is beneficial to the issuer. It protects against a scenario like this where interest rates go down. And now let's look at the two possible reasons for interest rates going down. One reason is that in general market rates are down. Another reason is that the company now has better credit quality. This rate of 10% is based on market rates and the credit quality of the issuer. Issuers with weak credit quality generally will have to pay high rates. Now let's say that for various reasons the credit quality of the company has improved. That means that the interest rate relevant for that company will come down and the bond price will go up. If the bond is callable, then the company can take advantage of the better credit quality. Callable bonds offer a higher yield and sell at a lower price relative to otherwise similar non-callable bonds. Let's say you have two bonds, bond A and bond C. They are similar in all respects except that bond C is callable. Now you are an investor. Which bond do you prefer? As an investor, you actually prefer bond A because you know that with bond A, the issuer will not call it back when interest rates go down. So as an investor, you are willing to pay a higher price for this straight bond relative to the callable bond. And higher price automatically means that the yield is lower for A. Therefore, with the callable bond, the price is lower and the yield is higher. Another way of looking at the same situation is that the investor doesn't really like this embedded call option, and to convince the investor to buy the bond, the issuer has to offer a higher yield. The bond indenture will specify whether the bond is callable or not, and then bonds will typically have a call schedule which says that the bond is callable after X number of years, it is callable at so and so price. What might also be specified is that after Y years, so let me just use numbers to make this clear, the indenture might say that for a 10-year bond, after 5 years, the bond is callable at 103% of par. After 7 years, the bond is callable at 102% of par, and so on. This schedule is specified in the bond indenture. Callable bonds come in different styles: American, European, and Bermuda. American style bonds are also called continuously callable bonds. With these bonds, the issuer has the option to call the bond on this day or any day after this particular day. With European style embedded options, the issuer can only call the bond back at particular dates. Bermuda style bonds are in between, which allow the issuer to call the bond back at specific dates, and those dates tend to be the coupon payment dates. Let's look at example 7 now. Assume a hypothetical 30-year bond is issued on this day at a price of 98.195. This is a percentage of par. Each bond has a par value of 1,000. The bond is callable in whole or in part on these dates at the option of the issuer. So notice this is the call schedule. The call schedule is telling us that the issuer can call back on this date at this price, and again this is a percentage of par. Notice that as we go further into the future, the price comes down. This is because if the issuer is calling back soon, then to compensate the investor, he is paying a relatively high amount. Now here is the first question. The call protection period is how many years? The call protection period is the period during which the issuer cannot call the bond. So if the bond is issued here at time 0, which is 2012, until 10 years later or 2022, the bond is not callable. Since this is a 10-year period, the call protection is 10 years. What is the call premium in 2026? So we look at this number. The call premium is the amount above par. So the amount above par is 2.3%. Remember, the par value is 1,000. So we take 2.3% of 1,000 and we get this number. The third question has to do with the style. The answer is a Bermuda call, because notice that on each of these dates, the bond is callable in whole or in part every 15th August. So since the series of dates has been given, this is a Bermuda call. Next we get to puttable bonds. A puttable bond gives the bondholder the right to sell the bond back to the issuer at a predetermined price on specified dates. Clearly, this is beneficial to the bondholder, because if the bond price comes down, then the bondholder can give the bond back to the issuer and get his money. This pre-specified selling price is particularly helpful if interest rates rise, and interest rates going up is the same thing as the bond price coming down, so it gives protection to the bondholder. When the bondholder gets his money back, he can reinvest that money at higher rates. Puttable bonds offer a lower yield and sell at a higher price relative to otherwise similar non-puttable bonds. And again, this makes sense. If you have bond A, which is a straight bond, no embedded options, and bond P, which is a puttable bond, obviously investors feel safer buying a puttable bond. Since investors like this put option, they are willing to pay a higher price, which means that they are willing to accept a lower yield. Details related to the put option, such as the redemption dates and prices, are specified in the bond indenture. Convertible bonds. A convertible bond is a hybrid security with both debt and equity features. It gives the bondholder the right to exchange the bond for a specified number of common shares in the issuing company. This is beneficial to the bondholder because it allows the bondholder to participate in the equity upside. So if a given bond is convertible into 10 shares of common stock and the common stock starts doing really well, then the bondholder can convert the bond into common shares and benefit from the fact that the shares are going up. Downside protection, because let's say the shares start going down for some reason, then the bondholder can keep holding on to the bond and at least get his basic coupon payment. The convertible bond also has some advantages for the issuer. It reduces interest expense. What this means is that an issuer can pay a lower coupon rate for a convertible bond. Lower rate because the issuer is giving the investor this conversion option. In return for that conversion option, the issuer can pay a lower rate. The other obvious point is that if the investor converts the bond into equity, then that eliminates the debt. Obviously, the debt eliminated here is the debt associated with the convertible bond. The other debt still remains. Some terms that you need to know in the context of convertible bonds are given right here. The conversion price is the price per share at which the convertible bond can be converted into shares. The conversion ratio is the number of shares that each bond can be converted into. The conversion value is the current share price multiplied by the conversion ratio. We also have a term called the conversion premium, which is the difference between the convertible bond's market price and the conversion value. We have conversion parity if the conversion value is equal to the convertible bond's price. Another term that you need to be familiar with is warrant. A warrant is an attached option, not an embedded option. Attached in the sense that this has an identity of its own, as opposed to an embedded option which only exists in the context of a bond. Let's look at example 8 now. Which of the following is not an example of an embedded option? We've just talked about the fact that a call provision is an embedded option. A conversion provision also is an embedded option because the conversion only makes sense in the context of the bond. The warrant is an attached option, it is not embedded. The type of bonds with an embedded option that would most likely sell at a lower price than an otherwise similar bond without the embedded option. So lower price means that investors don't like the option. As we've discussed, investors actually like the put option because that in a sense guarantees that investors can give the bond back at a certain price. Investors also like the convertible option because that gives them the option to participate in equity upside. So for these two bonds, the investors would actually be willing to pay more. Investors don't like callable bonds because with a callable bond, the issuer can call the bond back when interest rates go down. So B is the best answer. The additional risk inherent to a callable bond is best described as credit risk, interest rate risk, reinvestment risk. We'll talk about these risks in more detail later, but clearly the answer is not credit risk. Credit risk has to do with the risk that the issuer will default. That's not what's happening here. In fact, it's quite the opposite. The issuer is paying back. Interest rate risk is also not the answer. The big issue is reinvestment risk. With a callable bond, the investor gets his money back when he probably doesn't want it. And the risk is that the money now has to be reinvested at a lower rate. So the issue is reinvestment risk. The put provision of a puttable bond limits the risk to the issuer. That's not true. It actually limits the risk to the bondholder because the bondholder can put the bond back into the lap of the issuer at a given price. So that reduces the risk for the bondholder. Does not materially affect the risk of either the issuer or the bondholder. This is not true. It does materially affect the risk of the bondholder. Assume that a convertible bond is issued in South Korea. Par value is $1 million and currently priced at 1,100,000. The underlying share price is this and the conversion ratio is 25:1. I have not talked about this terminology before, but we can discuss it here. To determine whether the bond is parity, above parity or below parity, we have to come up with the conversion value and compare that conversion value with the market price. The conversion value, which we have discussed, is the share price into the conversion ratio. So conversion value is 1 million. This is the value if the bond is converted. The market price of the bond is 1.1 million. When the conversion value is less than the market value, then we say that the condition is below parity. If the conversion value were greater than market value, then the condition would be above parity. If they are equal, then we'd say we have parity. Let us now do a quick summary of what we have studied in this reading. You need to understand the basic features of a fixed income security. The basic features include a bond's issuer, the maturity, the par value, which is also the principal amount which needs to be repaid, the coupon rate, the frequency of coupon payments, and the currency denomination. You need to understand the functions of a bond indenture. The bond indenture, which is also called the trust deed, is the legal agreement between the issuer and the bond holder. The indenture specifies lots of important information which the investor must read in order to understand the risk return profile of the bond. The indenture will specify the legal status of the issuer. It will specify where the cash will come from to make coupon payments and principal payments. There will be information about collateral and the relative seniority of the particular bond. With senior bonds, there will be a higher degree of claim against the assets. With junior or subordinated bonds, the claim on the underlying assets will be after the claim from senior bonds. The bond indenture will also specify whether there are any credit enhancements. Credit enhancements are generally used by securitized bonds. Credit enhancements can be internal or external. One of the most important aspects of the indenture is the covenants. Covenants can be affirmative or negative. Affirmative covenants indicate what the issuer must do. Negative covenants indicate what the issuer cannot do. Generally speaking, affirmative covenants tend to be administrative in nature. Negative covenants are often more restrictive in the sense that they materially impact what a company might do. You need to understand the legal, regulatory, and tax considerations associated with the bond in which you are investing. And the testable item here is to understand where a bond is issued. Broadly speaking, we have national bonds. National bonds could either be domestic or foreign. We talked about the US or the American example. If an American company such as Ford Motor Company issues bonds in America, those bonds would be called domestic bonds. If Toyota Motor Company issues bonds and sells those bonds, or those bonds are traded in America, then they are foreign bonds. Both the domestic and foreign bonds would be subject to regulation in the United States. So they would be regulated by the SEC. Another category of bonds is Euro bonds. Euro bonds are not regulated by a national authority such as SEC. So a high level point is that Euro bonds tend to be less regulated than national bonds. There are also tax considerations that you need to be aware of. There will be taxes on the coupon income, and that tax is typically equal to the regular income tax rate. And then there will also be a capital gains tax. In most countries, the short-term capital gains tax is higher than the long-term capital gains tax. You need to understand the cash flows of fixed income securities. Here we need to understand the cash flow related to the principal and the cash flow related to the coupon payments. At a high level, the cash flow related to the principal can be amortizing or non-amortizing. With an amortizing bond, the principal amount is paid over the life of the bond. With non-amortizing, the interest is paid during the life of the bond, but the principal amount is paid at the end. And then we have an intermediate category called partially amortizing bonds. With coupons, there are several different categories, but the two most important types are fixed coupon and floating rate. With fixed coupon, the coupon rate is fixed, whereas with floating rate bonds, the coupon payment is based on some rate such as LIBOR, and often there is a spread above LIBOR. So if the floating rate is LIBOR plus 50 basis points, this means that the payment at the end of a period is equal to LIBOR at the start of the period plus 0.5%. And finally, we talked about contingency provisions. These are embedded options. A callable bond is a bond where the issuer has the option to call the bond back at a certain price before the bond expires or before the bond matures. This is good for the issuer. A puttable bond is a bond where the bondholder can redeem the bond or return the bond and get his money before the bond expires. This is good for the bondholder. A convertible bond gives the bondholder the option to convert the bond into a certain number of shares of the company, and again, this is good for the bondholder. That brings us to the end of this reading. As I keep saying, read the summary. The summary in the curriculum is actually quite long and it is very good. Review the learning objectives. They are not that many, but you need to be able to say something sensible about each learning objective. I have gone over all the examples in this reading. So what I want you to do is at some point in the future, you do the examples on your own and make sure you get them right. These examples are extremely important and they cover material that is quite testable. Even the format is exactly like what you will see on the exam. Make sure you do the practice problems in the curriculum and try to do practice problems from other sources as well.